Hello everyone and welcome to our weekly educational webinar. My colleague Sai Mahesh and I would like to thank you for joining. So after holding a series of webinars about technical analysis approaches or different schools, today we chose to talk about harmonic patterns. Many traders rely solely on harmonic patterns during their trading. So they only use harmonic patterns or detect harmonic patterns and use them in order to set their trades. So what are harmonic patterns? Let's move to the next slide. So harmonic patterns are they are geometric patterns that you can detect with the help of Fibonacci tools. So you must have you must know the Fibonacci tools. We already had a webinar about the Fibonacci tool. You can find it on our YouTube channel. And in this webinar, we're gonna explain again the Fibonacci in brief. So so now let's continue with the harmonic patterns. So the first one who talked about harmonic patterns or who established harmonic patterns was H.M. Gartley. He talked about a 5-point pattern in his book. A 5-point pattern, it means that we have 4 swings, 4 price swings. So his book was Profits in the Stock Market back in 1932, so almost around 88 years ago. So after he highlighted the pattern, several traders tried to work on improving harmonic patterns knowledge to people. So this was a new idea that he highlighted, and then all the traders back then they used to they tried to improve his foundation and using maybe different tools. Among them the most known was Scott Carney, who added the Fibonacci levels to the detection of patterns, and also he wrote a book, The Harmonic Trader. So this is where harmonic patterns came from. The primary theory after these patterns is that there is harmony in price action. We all know that the market moves in waves, impulsive and corrective waves, and also we talked about this when we explained about the Elliott wave theory. So we have impulsive and corrective waves, and these waves, the type of these waves, they can help us in predicting the coming market move or predict the future movement in price. So knowing this, to detect harmonic patterns, you should start by detecting a shape on the chart similar to N or M or W. So it depends whether you are what type of patterns you are looking for. There are mainly most of the patterns, the most known patterns, they are of 5-point patterns where they form a shape of W or M. But there is also one known pattern. It is the ABCD pattern. It is a 4-point pattern with 3 swings. So in order to make it more easier to you to understand the logic behind harmonic patterns, we're going to start with the ABCD pattern, which is a 4-point pattern, 3 swings, and then we're going to talk about the 5-point patterns, or the most known patterns and repeated patterns. So this is for the harmonic patterns in brief. They are usually corrective patterns. So we have a certain trend. We have a reversal, a slight reversal, where this reversal is a corrective reversal. So we have a corrective reversal, and then on the break, or when this pattern ends, we have a continuation of the previous move and trend. So now let's jump to Fibonacci to have just a small knowledge about the Fibonacci, or just to refresh our memories. So the Fibonacci was founded by Leonardo Pisano. He's an Italian number theorist, almost in like 1,000 years ago. So his this sequence is constructed by adding the sum of 2 preceding numbers. So this is the sequence here. You can see we have 0, 1, 0 plus 1 is 1, 1 plus 1 is 2, 1 plus 2 is 3, 2 plus 3 is 5. So what you have to do is just add these the 2 preceding numbers in order to have the value of this number. Out of the above sequence, out of the sequence found here, just talked about, you can derive certain ratios. So if you just divide 13 by 21, you're gonna get almost 61.8 retracement, 0.618. If you just also do 21 over 34, you're gonna get also 0.618 almost. If you go for 34 over 55, you're gonna get also 0.618. So if we go, for example, for a 21 over 55, we're going to get the 38.2 or 0.382. If we go for 21 over 89, we're going to get the 23.6. All these ratios, we can find them on the Fibonacci retracement tool that we have on the MetaTrader 4 platform. Among these ratios, we have also the derivatives of these ratios. We have certain derivations from these ratios, where we have, for example, 1.618, and we have other, which is the golden the golden ratio, which is also by dividing 55 over 34, for example, 34 over 21. So you're gonna get this golden ratio. It's called golden ratio. Another complementing other complementing ratios are 0.382, 0.5, 1.41, 2.0, 2.24, 2.618, and etc. So we must know these ratios, since these ratios are very crucial and important in the detection of the harmonic patterns. Since the harmonic patterns, I'm going to explain them now, they rely solely on retracements and extensions. So we have certain retracements for a certain move, and then we have an extension for a move in order to project a certain end for the pattern in order to be followed by a move. So what are harmonic patterns? We have first we have to detect the pattern visually. We just, as I said, we have to look for patterns similar to N or W or M shape. A trader must rely on the Fibonacci extension to define a certain point, this or a certain area. This area, it is called the potential reversal zone, potential reversal area, or it is the completion, a potential completion of the pattern. So at this area here, I will be explaining on the chart how you can find this area. So on a certain area, you have to predict that the pattern, the harmonic pattern has ended, and now we're gonna have a breakout or a certain move that's going to be significant. So a potential zone, in order to detect a potential reversal zone area, usually there should be a couple of Fibonacci numbers converging, and the harmonic pattern should be completed. A trader can filter the potential reversal zone, so he can use different approaches of technical analysis in order to detect the potential reversal zone. So by using Fibonacci numbers, also they can rely on candlestick patterns for reversals. They can rely on classical technical analysis such as tops and bottoms, which are usually supports and resistances, also trend lines and other technical indicators. So I'm going to start by explaining the theory behind the harmonic patterns. So I'm just going to go to the MetaTrader 4 platform, and then we're going to go back to talk about the theory on the PowerPoint. So let's just use this clean area here on the chart. So what's after the logic of let's start with the ABCD pattern. It's very simple. We just have to detect a certain bottom in the market, and then we have a certain move. We have to detect a certain top. So when we have a certain notified bottom and the top, we have to point them for A and B. And after that, we're going to expect a certain retracement. So this retracement, it should construct a point C. And after this point C, we have to expect another continuation move for the previous trend, where it should be point D. So this is in simple the ABCD pattern. This is the logic behind it. We have a certain move up, and then we have a certain retracement for this move. We have to set the Fibonacci to know what are the retracements, and based on this retracement, we have to expect a certain impulsive move higher, which is called CD, and we plot the point D. So I'm just going to erase what I added now, and we're going to be more precise in this. Okay, so I'm gonna just have this AB points. I'm gonna just add a text. So I'm just gonna add point A here. I'm just gonna add point B here. So I have point AB. Now I expect a certain move lower, which could be from B to C. So let's just draw this move here. Let's make sure, for example, it's the Fibonacci. This is on 61.8% Fibonacci. So now here we have point C. We can add point C here. So now we have point C here, and now we have to expect, after finishing this retracement here, now we have to expect a certain move up, an impulsive move, a continuation for the previous move that occurred from A to B. So we're gonna just, in order to expect this move, we're gonna do this. Let's just turn off these and just delete this Fibo. Now we're gonna go for an extension of BC. So we have to set targets for this move higher. So we have certain ratios that if the market retraces 61.8, the next move is gonna be targeting 1.618 of the BC. So from here, the market should be expected to reach this point here, and here we can plot the. So here we have this ABCD pattern. So, so by just assuming this, also we can have another assumption that if we just go for this movement from A to B, the other point, the point here that should be point D, usually it should be around 127 extension from A to B. Usually for the ABCD pattern, we just have to look that AB must equal to CD or almost equal to CD, and also the time taken between to form AB. So for example, let's say from A to B it took around 10 days. Also C and D must take around 10 days, 8 days to 12 days in order to form, in order to have better validity for the formation of this pattern. So by using this, by making sure that we have these ratios in time and in price, we have more validity for the pattern. And after this move here, after this pattern completes, now we expect the market to move down. So when we just when we set the ratios, so when we add this Fibonacci here, when we just draw the Fibonacci from B to C and we have this extension above 61.8 area, we should start expecting some reversal somewhere here. So we have to expect a reversal somewhere here. And also, in order to be more solid on this reversal, not just rely on the Fibonacci retracements or the Fibonacci extensions here, we have to make sure that, for example, to merge it with a certain price level, with a pin bar on the candlestick patterns, with a previous trend line, with something. So just try to filter the potential reversal zone. So also, in order to detect a potential reversal zone, we have to make sure that just we just have a couple of extensions on the chart. So if we just put this like here, we also have these three levels, they are converging. So we have two levels converging here and two levels converging here and one in the middle. So we have to make sure to expect a reversal near this area here that should be highlighted. So so we have to expect a reversal here. A trader could enter a short trade anywhere in this area here, and they, depending on the risk appetite, they can set the stop loss either by using a Fibonacci extension ratios, other ratios, or by for example deciding their risk to reward ratio. So this is what they have to look out for. Also, another key takeaway that you have to look out for when talking about a harmonic pattern. So here, for example, we have this trend line. So what we are assuming after the formation of this pattern is that the market is gonna move closer to this trend line or reverse back to the mean. Maybe it can be followed with another move higher, or we just have another move lower. If we have another move higher, there's another formation, it's called three dives. So maybe we can have a three waves pattern. So this will have to you will have to reassess what happened in the market. So this is in theory how you have to look for your patterns. I'm just gonna go back to the PowerPoint presentation. This is the ABCD pattern, the bullish ABCD pattern, the one that we talked about. We talked about the bearish, so but this is the ABCD. We have the bullish formation and the bearish formation. And the bullish formation, we are looking for a move down A to B lower, and the retracement C, which can be from 0.382 retracement up to 0.886. And based on these levels, you have to expect the extension of point D, where you have to look out for the point reversal. Usually, for example, when we have a retracement of 38.2, the market extends to 124 or 2.24. If we have a 50% retracement, we have a 200% extension. If we have 61.8 retracement, we have 161.8 extension, and etc. So the bigger the retracement of C, the less the extension of D from B. So if this, for example, we have this move here. So the C is back higher, so the D should be expected to be closer to B. If we have a stronger trend and the small retracement, we can expect the D to fall lower than B, much lower than B. So this is, in brief, the ABCD pattern. We have the bullish pattern, AB, retracement C, and then an extension D. And then here we have to detect a certain reversal zone, and then the market is going to move up. And also we have the bearish ABCD pattern, which is made up of a move AB higher, a retracement C, and an extension D, and then we expect the move back lower with a bearish move lower. So here we have to detect the reversal zone, and then we short the market towards towards previous lows, maybe towards C or even towards A level. So you have to set the targets using your risk management. So this is behind the 4 points. This is what's behind the 4 points pattern. Just want to repeat that it's a 4-point harmonic pattern. It doesn't start with an X like all the 5-point patterns. I'm going to talk about 5-point patterns now. The AB should be equal to CD almost in price and in time. In a bullish pattern, the C can't be higher than A, and in a bearish pattern, C can be lower than A. So we can't have this pattern here, for example. We can't just have AB and then have a C higher and then D. This point C shouldn't extend above point A. So it shouldn't go above A. It can go up to 0.86, 0.886 retracement of A and B, but it can't exceed it can't exceed point A. So this is what you have to keep in mind. This is one of the key pillars for a harmonic pattern. The bigger the retracement, the smaller the extension, as we explained. Now we have also the 5-point. The 5-point is similar to the 4-point, but it consists of 4 swings instead of 3. Now we have here 3 swings, 1, 2, and 3, and then the outcome. The other ones, we have 4 swings. So we have, for example, let's just have a similar formation. We have here, we start with X. So we have X, A, B, C, and D formation. So we have a certain trend, we have a corrective reversal, and then we have a continuation after the break from after the continuation or the completion of the harmonic pattern. So X, A, B, C, D, and we have here, for example, a move lower, and we have X, A, B, C, D. So now Sai in a while is gonna explain different popular formations of harmonic patterns. There are a couple of very important patterns in harmonic. What differs is the retracements and the extensions. So for example, how much B can retrace of XA, and how much B and C will retrace out of AB. Usually most of them can retrace between 0.3082 and 0.886, so this is not a matter. But also we have to mind the extension of D above B, or the extension of D above even X. So that's what differs in the coming patterns that Sai is going to talk about in a while. Sai?
Hi, thank you, Wael. Hello everyone, hope everyone is doing good. I guess, I assume like by now you'll be familiar with applying a Fibonacci retracements, extension levels, everything. So below there are different types of harmonic patterns, which is properly used for taking harmonic base trace basically. So where we're going to discuss about 4 more popular harmonic patterns, starting with Gartley. So as Wael was explaining to you, there are 4 points, which is compared with X, which act as a 5th point. So which where the Gartley, we're identifying the particular XA, that is the actual start of to identify the Gartley patterns. So basically in Gartley shape, the price action are going to be on an uptrend or downtrend. It may begins with the corrections basically, because basically the Fibonacci retrace itself a corrections. So based on the corrections, the percentage of corrections, we are going to take the structure of the patterns, how A, B, C, D, where D is going to be a potential zone of entry. So here in says, if we're talking about a Gartley shape of patterns, so normally like you can see here the bullish cattle and there is a bearish cattle. So where XA, B, C, D. So D is a potential zone for the entry. So it's like a bullish where you're going to continue further to the high. So your entry would be going to be here. So in this case, like exactly opposite side of the Gartley, bearish Gartley, which is the XA, B, C, BC, and D, which is going to be a bearish one. So to be very clearly explained, based on the retracement levels, the percentage of levels, this has been categorized. As I said, like there are 4 types of patterns, so we are going to see here. So the Gartley patterns are published by the HM Gartley, which are profit in stock markets, profits in the stock markets. Fibonacci levels added by the Scott Kearney. So he's a harmonic trader basically. So we're going to explain these 4 types or the different types like A, X, A, B, B, C, C, D. So where the D is going to be there, your potential zones. So normally like the retracement level is a very important here. So where are we going to be? So AB must, I'll talk about the retracement percentage itself, since you want to know about knowledge about the Fibonacci in the percentage wise, like 63, 38, like 78, something like that. So it will be very easy to understand such way. So AB must retrace to 61.8% of XA. So you can talk about the leg XA leg. Maybe we can talk about BC to retrace between the 38 to 88%, 6% of AB. So CD could be extension to 1.3. Maybe like 1.6, so that CD will be retraced to up to 78%. So that is exactly that. So D is normally meant as your potential level of trading. So once you have been buy on your call on the B positions, you can be your targets to 61%, or you can be on 127% of a CD level, CD legs. So this is all exactly the patterns has been designed. To be very knowledgeable to know about it, once you're thorough on the Fibonacci retracement, this will be easy to understand because it's completely based on Fibonacci theory. So much later, that Scott has been identified other patterns also comparative with this Gartley's patterns, like grab, bat, butterfly patterns are there. So this logically behind these patterns remains the same like Gartley, but only thing to identify the patterns is different from the Gartley, which is looks in a different patterns on this way. So here where we're going to see the next one is that it's a butterfly pattern. From the name itself, we can understand that it looks like a butterfly way. When you're talking about the grab, it looks like a grab a portion of shape, or you can say with the bat patterns looks like a pattern. So it's very easy to identify, easy to understand the pattern's name. And similarly, we can also understand by knowing about the butterflies. So here what you're seeing in previous one, it was extended here, the D was extended here, right? So the XA, the AB, a BC, and the D. So here your entry level, this is a potential reversal point here, where it's going to be on a bullish side. So against of the opposite side of the pattern is, which is a bearish side. So again, there will be a, so now I'm going to give you the levels of percentage, how exactly the percentage works on the retracement. It differs from Gartley when the point D is extended to behind the starting point. That's what I was saying to you. So when talking about the AB retracements, like which basically works like AB must retrace to 78%, for example, 78.6% of XA. Again, you're talking about BC must retrace to the extent of 38% of AB. CD must extension to 161 or some other further extension. So CD can also extend to like 127% or 161 in case of bullish trend. So this is how exactly the patterns have been designed. So to understand this, like you have to practice on these patterns to one see the different level of retracement, defining that this retracement has been achieved this level. So there are 4 categories on this. So among the next is a bat pattern. So the bat pattern, like it's a bat pattern, is similar to the Gartley appearance, but not in the measurements. That's only the difference with all the patterns basically. So here you can see there is a type of extension like XA, the B is here, and the C, and the D. So it's almost near to the D basically. So in the same way, when you see the XA and reversal side or the bearish side, again it's almost near to the D. That means the extension, the correction, the retracements was nearly, it's almost covered almost to the X. So X of A. So this is all exactly the identifying the back patterns. So here we're going to see here like what are the levels going to be seen in this particular one is that, for example, like AB can retrace to between 38.2%, BC can retrace to 38% of the AB legs, CD to retrace to 88%, and CD can extension to 161 or 122 point something. So after this patterns established, they take a position on the D, which is targeting for 61% of or 127% of CD level. So this is how exactly it looks like, almost a W or almost like a reversible W pattern. That's why it's called as a back. So this is among 3-1. So next one is that we are going to move on to the last one, the graph patterns. So here we can see from the figure, we can see like X, the D, CD is more extended to more than the X. So that means like it's almost above the X level. So XA, AB, BC, C is being extended below the X. So it means it's crossed here to D, the new level of the corrections. So extension is being made to D. So as I said, while we can identify by your support or resistance level, or maybe any indicators, or maybe like very good in getting out a clear indication from the candlesticks pattern, this will help you to know the reversal, the potential reversal point actually. So here you can see the D, which is going to be on a bullish side. Exactly the opposite side of the bearish is that the same way where the X, the D is going to be the more than the X. So this is how exactly it looks like. Where we're going to see the levels now. One of the most precise patterns according to the Scott training hits the reversal as the extremes, because it's going to be a reversal in a big way when you see this type of patterns, the graph patterns, because since there is a big fall in the market or big rise in the market, because to identify the D, because it's extended more than the X value. So it's going to be a big move in the market when this type of patterns occurs in the in your graph. So basically, the graph is considered to be a Scott to be one of the most precise, as I said. Like so, AB leg must retrace anywhere between like 38% up to 61%, and for example, BC must retrace to 38%, and CD to extend to 161% or maybe like that. So CD may be extended to more than that, because the rally of the D, the potential it is more like the extension of the target will be higher and higher, since there is a big retracement happened below the X point. So definitely there will be a big rally in the. So these are the major 4 patterns of harmonic patterns. So first of all, we need to see this if potential B is formed. That's the most important thing in this all the patterns. So when after you see the B pattern, the momentum of B, you can identify the retracement, because after that the retracement starts. Yeah, because XA is normally a point where it's taking from the corrections to the A point. But after A, there is a B. The B is the main, the first one to know about what exactly. Because based on the B momentum or B correction only, will come to know which type of patterns the particular market is moving on. So based on the B, if it retraces to 38% or 50%, it's mean a back pattern, or 78% is a butterfly pattern, or it is a 38% or 61% is a graph pattern, or 61% is a Gartley pattern. So based on that, we can identify. So this retracement, it's against it's comparing of XA levels, XA which is a retracement of this much level. So exactly that. So always please note in that this type of patterns, it's all works in weekly, daily, or we can say 4-hour chart, even to 30 minutes, even to 30 minutes. The bigger the duration of the stronger the patterns, you always give through a big profitable, vice versa. So the smaller time duration, definitely the 30-minute charts also gives a patterns on an everyday basis, whereas the dailies and weeklies gives you on few months once, or in a couple of months something, because the longer durations definitely take a longer indication to give the to identify the particular. So in case of targets and stop loss, as Wael was saying, like in case of 30 minutes, it could be a smaller return. And if it's multiple patterns occurred with your 1 day, or maybe giving high returns with the limited pattern formation. So that is like, so 30-minute chart, you will see a result in a 1 day or two, maybe in case of a continuity is there in the particular pattern. But in case of daily chart, it may take weekly or monthly. That's how exactly. So as you choose, like as per your convenient, as per your plan of risk management, you can choose which type of chart you want to trade. So based on the risk is be calculated. But I said like it's a longer durations, give a longer trend. Basically, this type of patterns, harmonic patterns, are be mainly used by the position traders basically. So they are always look into the trend markets, because there is, if for example take for a gold, there was running towards on appreciation goal. I mean the markets on the one side, and there is some correction happen, and definitely this correction will give you the levels of which A, B, or CD, what are the things happening in the markets. So this will give the correct retracement. From the retracement, it's going to be corrected back to extension to other level or to the to identify the deep potential. So this is how exactly the markets are provided. So I'm sure now that you're start identifying these patterns and start take advantage on the price momentum. So pretty much will be have a very good to level to exactly find the reversal where exactly the correction, and many traders are there in the reversal markets basically. So those are very willing to take. So patterns it take time to identify, but really it's worth it. So that's all about for today. Thank you for all.
I'm just gonna go to the live chart to gold in order to show you how gold was trading using a harmonic pattern and how the price action that happened the past couple of days was a formation of a certain harmonic pattern. So this is the chart of gold. This is the hourly chart. So if you just have to look at this this move higher, we have a certain detection for point A to point B. Remember the first pattern that I talked about, the ABCD pattern. So we have point A here and we have point B here. And here we have a very clear retracement. So once this clear retracement happened, we have to plot point C. So if we just go for the Fibonacci here, we can go check the retracement of the move higher. We can see that the market retraced exactly 38.2%. So this could mean that we are forming a certain harmonic pattern. So a trader must definitely start looking for a continuation for this move or an equal leg here. So if we just go for a certain extension, so we just have to set a certain validation for this move, we have to use the Fibonacci retracement of the move that happened lower or the correction. So we just draw Fibonacci retracement from here to here. Remember that the market retraced 38.2, and there's a certain explanation that when the market retraces 38.2, the extension of point D will be 224 or 2.24, which was exactly 2073 and was exactly the highest price that gold reached. So if we just draw this here, we can see that the market had a 38.2 retracement, and then it had another extension of 224 of B and C. So this shows that that we are almost approaching a reversal zone, and this reversal zone was around 2075. So if we go also we can use this for the extension. We can see that above 2027 and between 20 to 2095 we had to expect a certain reversal in price, but we would just have to go for the classic way of determining the extension of point D. We can just rely on this, a 38.2 retracement from BC of AB. We have to expect an extension towards 224, which was 2073, and the market settled atop here, and then the market moved down. So this is one of the live live patterns on gold. I'm gonna do another one for this correction here. So we said that we have a certain also a certain 5-point move. It is called the crab, and the crab point D is extended too much from X, and it has a certain extensions as I mentioned and as I showed. It can reach up to 2.618 or 3.618 of B, and you can see here that D is so extended from X and is so away from the formation, the topping formation that was made. So if we just go for this retracement here, we have this point X here. If we're just gonna check the retracement here, we have almost 50% retracement, and we said that with grab the market can retrace or AB can retrace up to 50 or 60% retracement from X. So we can draw X here. This is X, this is A, And then after that, we had this move here, a retracement of around 50 to 60% retracement. So we have point C here. So we can set point B here, and we set point C here. And now we have to expect where D should come. So in order to expect where D can come, by these Fibonacci retracement levels here, I can suggest that it could be a crab pattern happening. So if I just go for this, I just set this extension from AB lower in order to set the extensions. I can see that the market almost reached 361.8, and then we reversed from there around 100 points, around almost $90 from bottom of 1860 towards a high of 1950. So this could mean that we are in this pattern, which could be a crab pattern. So we had this move here, XA, and then we had a retracement AB of XA, and then retracement BC of AB, and then we had this extension CD, and currently we are going back to the trend line that that can be drawn. Also, if we just want to filter the market move here, we can just go for the daily chart. We can draw this trend line. We can see that the market exactly was at this trend line. We can also add this Fibonacci from the least bottom towards the top. We can see that it's almost 76.4, 78.6 retracement. So also we have this. So by using the harmonic pattern analysis on the hourly chart, and by merging what's happening here on the chart, we have a trend line, we have a Fibonacci retracement, and we have an extension of the Fibonacci for CD for a crab pattern, and the market retraced, or the market bounced sharply from this trend line, from this point, from 1860 towards 1950, which is almost around $90 per ounce. So this shows the validity of these patterns in your intraday trading or in your daily trading. So this is all for today. I just want to remind you that all the information, analysis, news, and opinion mentioned in this webinar are only for educational purposes and shouldn't be taken as a signal whether to buy or to sell any financial instruments. We are only showing you these examples in order to help you know how to do your analysis on your own, on how to start detecting these patterns and how you can improve your trading. Definitely, if you're just new to this, it's gonna take you some time to find these patterns, to start detect these patterns. But once you have first and second and third successful patterns, it will be very easy to you, and you will start benefiting from your own knowledge. So this is for today. This is the webinar for today. If you have any questions, please write them down so we can answer you. I'd just like to remind you for the last time that all the opinions, analysis, news, and information mentioned in this webinar only serve for educational purposes and shouldn't be taken as a signal whether to buy or to sell any financial instrument, and ICM doesn't provide any investment advice. Okay, so someone just missed the first four pages. It was just the basics of harmonic patterns, how they were found. They were found by H.M. Gartley back in 1932. He mentioned a five-point pattern in his book Profits in the Stock Market, and then Scott Carney, he added to the Fibonacci levels in order to detect more precise patterns. So this is all about it. I just want to also to remind that all the harmonic patterns are usually reversal corrective patterns, so they just happen as a corrective formation, and then we have a continuation of the previous move. Also, we mentioned that the primary theory uh, of the harmonic patterns is that there is a harmony in price action and price and time movements, and the market moves in waves which can support the prediction of a certain move. And usually in order to look for a 5-point pattern, you have to look for shapes similar to W or M, and for 4-point pattern, which is A, B, C, D, you can look for the N shape. And we also talked about the Fibonacci sequence and where did they come from, and this is mainly it. So Just if you missed any, you can just watch the rerun that will be published on our social media channels or on our YouTube channel. So there is a question: which time frame should we use for harmonic patterns? XEU is trading all high. Okay, so it doesn't really matter uh, which so there's no precision for a certain time frame. You can find some patterns on 1 minute time frame. You can find some patterns on 15 minutes time frame, on 30 minutes, on 1 hour. But usually when the time frame is bigger, the move of the pattern could be much bigger, and this would be maybe supportive to your risk management. So that's it. Usually harmonic patterns that are formed on hourly time frames, they are more reliant than other patterns. Well, there's no certain precision for these patterns. There is no certain accuracy, but usually they happen more often, and they have a certain success rate. But it's not there is nothing generic for the success rate of these patterns. And especially what's best about these patterns is that they are solidly technical. But in order to have better achievement, we always talk about this, that you have to merge what the chart is giving you with the fundamental analysis, so you can have a better outcome. Okay, so someone is asking why gold dropped this much. If you just have a certain look, just a small look on gold compared to U.S. Treasury yields, we witnessed the rally in U.S. Treasury yields, and the main reason behind this gold rally to the upside was that the near zero interest rates by top central banks made gold, the non-yielding bullion, made it more attractive to investors. So they jumped to gold, and that's what happened. We witnessed an upside rally. But due to the solid job gains on Friday and the positive PPI yesterday, and these positive economic indicators that we're getting out, the bets on further monetary policy stimulus is just reduced. So by this, we witnessed the rally in yields. So yields jumped higher, and as yields jumped higher, gold moved lower. So we can have a certain I'm gonna show you a certain a chart that's gonna compare gold to treasury yields. I'm gonna show it to you just in a while. So I'm just gonna add this so you can check it. So here you can have this. You can just have this look. This is the movement of gold prices. This is the movement of gold price yesterday. This is the 15 minutes chart. You can see as yields were down, gold was topping. But when yields started reversing to the upside, we witnessed gold going down. So this formation here. If you can just notice this, and then the market went up. If we just go do the opposite, we had the completely opposite move. We had this here, and then we had this, the correction, the retracement, and then the market had little retracement here, and then one way down. So this what this was clear. We had these bottoming for the US yields, and we have these stops for gold. Aside, there is a question if you'd like to answer. It's is harmonic pattern same like Elliott wave?
Yeah, not really, but similar to the way you understand the wave, it's different, but the retracement is level is different, right? So it's exactly a different level of understanding. But harmonic patterns is completely based on the Fibonacci and the measurement of the retracements. It's only purely based on that. As you while you're showing about the gold, which clearly indicate on a daily chart, which is clearly mentioned the X, the A, the BC was how much corrections, and the D was potentially what is what's shown in it. So it's like that. So basically, it's purely measured on a retracements of the percentage.
Thank you, Sai. Any further questions before ending today's session? Okay, so yeah, we talked about Elliott waves a couple of webinars back, so you can just find it on our YouTube channel. There's a session, the full session about Elliott wave theory. Okay, perfect. I believe this is it for today. If you have any questions, you can write an email to webinar@icm.com or support@icm.com. I just to remind you one more time that all the opinions, analysis, news, and information are only for educational purposes. So thank you for joining, and hopefully we'll catch you with the next webinars next week.
Thank you, everyone.
Would you like to add anything?
Thank you, everyone.